skills enable them to outperform the market return. Research by the New York Stock Exchange listed State Street Corporation says that it's simply not possible for most funds to outperform the market. So from our Cape Town studios, we're now joined by the Chief Executive Officer of 10X, Stephen Nathan. Stephen, thank you very much indeed. You support the research outcomes that active fund managers can never outperform the markets. But let's start at the beginning. What is the difference between an active and a non-active fund manager?
Well, a non-active or a passive fund manager tracks the market. So if the stock market in a year goes up 15%, then a tracker fund or an index fund will return 15%. An active manager says, I can do better. I can pick those winning shares and avoid those losing shares. And by selectively buying and selling those shares, they hope to earn a return that beats the market or the index.
All right, so you reckon that it's not possible to consistently beat the market?
Well, investing is a zero-sum game. So for every winner, there's a loser. So if I buy a share that does really well, someone has to sell me that share. And that's a zero-sum game before costs. But when you factor the cost of trying to beat the market, paying the active fund managers, paying performance fees for those few funds that do better, those funds that do worse don't write you a check back as an investor, so they don't compensate you for underperformance. And when you buy and sell shares, you pay taxes and brokerage. So it's impossible for the average fund to beat the market after all those fees.
So I'm Joe Soap. How do I go about finding the difference between passive, non-passive? Where should I be putting my money?
Well, it's quite hard. Passive funds easy because you just get the index. But the active funds, one of the difficulties in choosing those is there's hundreds of different funds and they all have different return payoffs. And when you try and invest on past performance, most of us look at what's done well last year, but very often that doesn't lead to what's done well into the future. So really, as an investor, you want to be sensible. You want to own portfolios that are diversified, and very importantly, you want to minimize the total costs.
All right, so when you say diversified, is that a little bit of a mix between active and passive, or just in different baskets?
Different baskets. So you don't want to own, for example, just South African equity shares, stock shares that are listed on the stock market. You want to own some property, some cash, some bonds, and you also want to have some offshore, because diversification is the only way to actually improve long-term returns without taking on too much risk.
All right, so costs is the thing that you've been saying quite a bit. How do you even start to know what is reasonable?
Well, the first thing is you have to ask. So ask your advisor or the provider, or look on the documentation and make sure they're disclosing every single cost that you would incur as an investor. And then you need to understand cost in the context of your returns, because when you look at long-term returns, you earn about 5 or 6% after inflation per year. So every 1% that you're paying in cost, this is cost as a percentage of your investment balance, is actually not really 1%. It could be 20%, 1/5 of your return after inflation, and that compounds every year to erode even more value. So costs are very important. Find out what they are. Try and negotiate costs. A lot of people don't know that they can negotiate costs, and by so doing would capture more of the return, and that can have a very significant impact on the long-term value that you see out of your fund.
And I would imagine, I mean, I'm looking at the JSE sitting above 45,000 points at the minute. This is a really a long-term game, whereas, as you're saying with these active managers, they're dealing on short-term decisions, aren't they?
Without a doubt. Now, if you look at the stock market when it was about 35,000, a lot of the fund managers were saying, no, the market looks fully valued, you want to be conservative from here. And that's the difficulty as a fund manager. We just really don't know where returns are going to be over the short run. So as an investor implies that you have a long time horizon, really 5 years and longer. And then, as you say, focus on the long term, buy the well-diversified portfolios and minimize costs, and don't try and guess what's going to happen next week, because nobody really knows.
All right, so I'm Mr. Investor. What's your best advice for me? I'm sitting with a bit of cash. What do I do?
Well, the first thing, as we've said, is own diversified portfolios. And you should really invest according to your age, because you want to own shares because they do give you the highest long-term return, but they're bumpy in the short run, they're volatile. So you want to own, if you've got a long-term horizon, which as I said is 5 years plus, own a balanced fund with a high equity weighting. It might be called an aggressive or a high equity fund, but it's about 70% sitting in equities. Diversify well, have some offshore exposure, and then minimize fees and try and save for as long as you can, and don't get tempted by all the short-term noise and the volatility of the markets.
All right, so it's safe bet with these long-term funds, I guess, but the money is in those people that are really clever and can outthink the market. You'll get really good returns there. There must be some people who've figured it out.
Well, we can only know who's done well in the past. So, we all know the fund managers that have done really well in the past, but even those fund managers don't just have one fund. So even if you think that XYZ is a good fund management company, you've still got to go and look at 30, 40, maybe 50 portfolios to choose from. So unless you really have expertise and have unique insights into the market or into fund managers, then for most people, you should be owning a low-cost index fund. And that even applies to professionals. The research that is done overseas says that even the vast majority of active fund managers invest quite a lot of their own money in index funds because of the low cost and because of the risk of underperforming the market with active managers.
All right, without putting you on the spot too much, which sort of sectors, types of funds are doing the best at the moment? Which areas?
Well, equities, as you said, equities have done really well. So if you own what we call risky assets, those are things like shares, they've done really well. Obviously, owning cash you don't do well because you get a return that matches the market. Sorry, that matches inflation. So in South Africa, shares have done really well. Mining shares haven't done well. Shares like Naspers have done really fantastically well. South African Breweries has done well, and Richemont has done well, the big international luxury goods company. So there's pockets of shares that have done really well. But as an investor, we don't really know which individual shares are going to do well in the future. That's why you want to diversify your portfolio. You don't want to be too greedy, because if you look at the returns, they tend to come from a few shares. Maybe 5 or 6 shares do really well, but those shares keep on changing, and it's very difficult to consistently predict those ahead of the time.
All right, Stephen, we're going to have to leave it there, but essentially what he's saying is err on the side of caution. Diversity is the name of the game, and long-term is probably the way you want to look at your investments. Stephen Nathan is Chief Executive Officer of 10X in Cape Town.